Imagine a stock nearly doubling in price because of a company that wasn't even public yet. That's exactly what happened to Virgin Galactic. For weeks leading up to SpaceX's IPO, traders were hunting for any way to play the commercial space story. SpaceX wasn't public yet, so the next best move was to buy the closest publicly listed cousin, Virgin Galactic, ticker SPCE. And it worked, briefly. SPCE ran up nearly 160% on pure hype and momentum. Then SpaceX actually went public on June 12, 2026, pulling off the largest IPO in stock market history, raising $75 billion at $135 a share. And I mean history. It beat Saudi Aramco's $25.6 billion record from 2019 by almost 3 times. With the green shoe option exercised by June 15th, the total haul climbed to $85.7 billion, over $350 billion in total orders. This thing was insane, and the moment SpaceX rang the opening bell on Nasdaq, Virgin Galactic dropped more than 30%. Just like that, the hype trade evaporated overnight. So here's the real question. Is this a classic buy the rumor, sell the news pullback that deserves a second look? Or is Virgin Galactic a trap dressed up as an opportunity? That's exactly what we're going to break down today. This video expands on my recent article for Barchart. The link to read it fully is in the description. If you're into stocks and markets, hit that like button and subscribe for more breakdowns like this. Let's get into it. Virgin Galactic, ticker SPCE, has been the retail go-to for space tourism dreams for years. As of this recording, the stock is trading around the $3.56 level after that vicious post-IPO unwind. On May 15th, 2026, Virgin Galactic dropped its Q1 2026 earnings report. Revenue came in at $0.2 million, not $200 million. Not $2 million, $200,000, and that was actually down from $0.5 million in the same quarter a year earlier. A company with a $358 million equity valuation is generating revenue that wouldn't cover a decent lunch catering bill in Manhattan. The loss per share came in at 81 cents, missing Wall Street's already pessimistic estimate of 79 cents by 2.5%. Net loss for the quarter was $65 million. Now, that is better than the $84 million loss a year ago. But here's the key detail. That improvement came from cutting spending, not from actually selling more tickets. The company isn't growing its way to profit, it's shrinking its way towards survival. Free cash flow was deeply negative at negative $93 million. And to keep the lights on, they raised $11 million by issuing 4 million new shares through their at-the-market program, which is a polite way of saying they diluted existing shareholders. Now, the financials alone could scare anyone off. But there's a reason some investors are still in this name, and it comes down to execution. Now, cash on hand was $251 million as of March 31st, 2026. That's the runway. And that leads perfectly to what management is actually doing with it. Virgin Galactic isn't just sitting there burning cash, they have a plan. First big move, they reopened ticket sales in March 2026 at $750,000 per seat, up $100,000 from the last time they sold tickets, nearly 2 years ago. So they're going full luxury, high price, low volume. The logic? If you can afford a $750,000 ticket to suborbital space, you're probably not comparison shopping. TD Cowen actually likes this strategy. Their read is that Virgin is targeting a high demand, low supply luxury market with a credible path to profitability. Customer revenue expected by year-end 2026, positive cash flow targeted for 2027. They even put a price target of $4.50 on the stock, On the hardware side, they're moving from the old Unity vehicle to the new Delta-class ships, built for higher reuse with internal plans for 8 to 10 flights per month. Each Delta ship carries 6 passengers instead of 4. They've also hired a Chief Growth Officer, Megan Pritchard, with a mandate to expand spaceports and lock in high-end brand partnerships. The roadmap sounds reasonable, but every single target, Delta ships performing, tickets selling, partnerships materializing, requires near flawless execution from a company that's been in show-me mode for years. And now they're doing it while sitting in the shadow of a $2 trillion SpaceX that just pulled off the biggest IPO in history. No pressure. So what does Wall Street actually make of all this? Nine analysts cover SPCE. The consensus? Hold. The average 12-month price target is $3.29, which, as of this recording, SPCE has already marginally surpassed at roughly $3.50. That means by the street's average math, there's basically nothing left on the table. But here's the number that should get your attention. The street high target is $5. That's about 50% upside from current levels. The next earnings date is August 5th, 2026. The estimate for the June quarter is a loss of 79 cents per share versus a loss of $1.47 in the same quarter last year. That's a 46% year-over-year improvement. Losses are narrowing. That's real, but we're still a long way from a profit line. And here's the macro context you can't ignore. SpaceX just absorbed a massive chunk of the risk capital that used to flow into proxy trades like SPCE. Investors who were buying Virgin Galactic because they couldn't own SpaceX, they now own SpaceX directly. That rotation is done. The residual question is whether SPCE can build its own investment case from scratch. Without the SpaceX tailwind, that brings me to my honest take. My balanced take? SPCE is not a value play, it's a momentum and execution lottery ticket. The post-SpaceX IPO sell-off isn't a gift, it's a warning that capital has better options in space now. I'd want to see real customer revenue and a credible path to positive cash flow confirmed in the August 5th, 2026 earnings call before putting serious money here. If you own it, watch August 5th closely. If you don't, you're not missing a sure thing, you're missing a coin flip. This is not financial advice. Always do your own research before buying any stock. Past performance does not guarantee future results. If this helped, smash the like button, subscribe and turn on notifications. Drop a comment. What do you think about SPCE? Is it a dip worth buying or a trap? Which stock should I cover next? I'll see you in the next one.